Good morning. Welcome back to the Broadcast Retirement Network. This is BRNAM for Friday, May 17th, 2024. And our top story today, we're going to take a look at the state of commercial real estate. Joining me now to discuss this and a lot more, John Affleck is a Senior Director for U.S. Research at CBRE Investment Management. John, so great to see you. Thanks so much for joining us on the program this morning.
No, my pleasure, Jeff. Thanks so much for having me on the show. I expect most of your viewers have heard of CBRE. It is, after all, the largest real estate investment services company in the world. Now, I work for the investment arm of CBRE, CBRE Investment Management. We own and operate on behalf of our investors about $150 billion in commercial real estate across our various funds, which include direct private investments, where we own an asset outright, our private infrastructure platforms, and our listed funds.
And with that, John, I mean, this is perfect because we're going to talk about the state of commercial real estate. Let's start with the basic question. How is commercial real estate doing? And by commercial real estate, we're talking offices, data centers, retail. There's a lot that goes into that. So in general, how is commercial real estate doing?
Yeah, Jeff, I might say it's been the best of times and the worst of times these past few years. During COVID in 21 and 22, we saw some of the best commercial real estate returns on record, especially for logistics, which is what we call warehouses, for apartments, for life science, for self-storage, and more recently for data centers. Demand in these sectors absolutely soared during COVID. Vacancies fell to record levels, rents skyrocketed, and debt costs, an important topic, fell with interest rates to very low levels. But these conditions also kicked off a record supply wave that's delivering just as demand is normalizing after the pandemic. And of course, interest rates have risen, which has also significantly increased debt costs for commercial real estate and consequently led to higher cap rates and falling valuations.
John, are there bright spots? And we often hear in the press, and TV shows and podcasts, et cetera, about the office vacancies. You just kind of alluded to that people, there's been this battle going on between the office worker and the employer. People don't really want to come back, at least not full time. But are there some other bright spots? You mentioned data centers, retail, other areas that really pop out now.
Yeah, absolutely. We've never seen quite so much divergence between the different food groups, as we call them. Office, as you note, is as challenged as it's ever been in its history. But the other segments are in really quite good shape, actually. The main problem facing, for example, logistics in the apartment sectors is that record amount of new supply, which is delivering right as demand is kind of returning to more normal levels. And that's caused vacancies to rise from record lows. Vacancies are still really low in those sectors. And we're expecting that the higher interest, and we've already seen, in fact, that higher interest rates, tight credit conditions have shut down construction over the past few years. So looking ahead, we can see on the horizon in a couple of years, a period of time where supply is below trend, is really quite limited in these sectors. And indeed, in the apartment sector in particular, the overbuilding of the last couple of years only began to correct a full decade of underinvestment that, of course, has left the U.S. with a massive housing shortage. And it's barely put a dent in it, frankly, the supply we've seen over the last couple of years. So we really like the long-term structural drivers of, in particular, logistics and apartment in the U.S.
And John, just as a follow-up to that, geographically, I mean, when I think of commercial real estate, having lived and worked in New York, in the New York area, of course, think of Gotham. I think of New York City. I think of some of the bigger cities. But what stands out geographically when you look at the total United States? Because your portfolio, not your personal portfolio, but the firm's portfolio is a real estate portfolio, very vast. So are there areas or pockets of areas that stand out to you?
Yeah, absolutely. We disaggregate the performance of commercial real estate into three broad components. First, you have to make the right sectoral bets, at a national or even global level. Second, once you've decided on the sectors that you'll invest in, which markets will you invest in? And that matters enormously. And a few markets are absolutely standing out right now. So first, Florida is absolutely having a moment. The rumors are true. A heady combination of tax-free income, warm weather, beaches, and relatively affordable housing has attracted a lot of professionals as well as firms to Florida, and especially South Florida. And that spurred really strong rent growth across every sector, even office. Actually, South Florida is really the one bright spot for the office market around the country. And I think we might generally say the same about that Sunbelt region, from say Phoenix all the way over to Charlotte and North Carolina. All of these markets, Charlotte, Nashville, Atlanta, Dallas, Phoenix, have also benefited from that same strong in-migration of folks looking for lower taxes, cheaper housing, maybe better weather. A lot of folks leaving California and the Northeast. And that in-migration has, again, spurred demand for housing and logistics in particular. And we also really like retail in some of these markets, because retail is the one sector that hasn't seen much new supply over the last decade, but a lot of new housing. And consequently, some of these markets, which are known for their shopping malls and retail, are maybe for the first time in a long time under-retailed.
John, one area that I wanted to ask you about is the conversion of available office space to residential. And is that, we have an aging society. America is getting older, as are other countries, and we're going to need housing for our seniors. How is that transition from commercial to residential happening? Is it possible? And what are some of the hangups or the challenges with doing that?
Yeah, absolutely. So it's certainly safe to say that the US has too much office space right now and not nearly enough houses. So it's a pretty obvious solution that converting offices into apartments would go a long way toward solving that, especially in some of the tightest housing markets like, say, New York. Now, this is not a new idea. Much of Lower Manhattan, including much of Wall Street, has already been converted into residential. And on average, since 2001, we've seen about 2 million square feet of office space in Manhattan converted into some other use, mostly apartments. So the first thing to note that in New York, a lot of the easy conversions have already happened. And generally, this is not a straightforward conversion, as you can imagine. First, there's simple architecture. Many office buildings have large floor plates, which will mean a lot of windowless rooms or wasted interior space when you convert that into apartments. Second, conversions are obviously very expensive, and we're going to need to see office prices fall to levels that can pencil in these underwriting models. And we're getting pretty close to that, frankly. Third, the office building needs to be empty, which can take some time for all those leases to expire. And finally, cities are going to need to rezone these traditional office areas to allow for residential uses, which is to say the public sector is going to need to take a pretty active role in changing zoning and regulations, and even maybe providing capital before we see conversions of office to resi at scale. Now, in just one example of how policy can encourage these conversions, downtown Manhattan allowed conversions to proceed floor by floor, which meant that the office owner didn't need to wait till the office was completely vacant. And consequently, that led to a lot of conversions downtown. Now, the nature of those buildings, those pre-war buildings, also was quite amenable to conversions as well.
Well, it's interesting that you bring that downtown Manhattan. I actually worked on Rector Street, and the building that we were working in actually converted to residential. John, I need to take a very quick break. We come back, we're going to talk about where does private and public real estate fit into your portfolio, or a portfolio. You're going to want to stay tuned right here on BRN. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We're joined this morning by John Affleck of CBRE Investment Management. John, thanks so much for staying with us this morning.
My pleasure.
I haven't lost a guest yet, by the way, which is always nice. My streak continues. No one's run off. Okay, John, before we get into the whether or not real estate should be in a portfolio, I have an idea about that. I want to ask you about interest rates, and you alluded to this in the first segment of the impact to interest rates. Let's talk a little bit more about that, because I think we could get some rate changes over the next couple of quarters. What's the impact of those rate changes, whether a raise or a decrease to real estate?
Yeah, the increase in interest rates has had a profound impact on commercial real estate capital markets. And I think capital markets in general, but maybe especially for commercial real estate, where debt is really important. Most commercial real estate investments do involve some debt. And the traditional model, of course, is to add some leverage to real estate, just like you would for your home mortgage. And it consequently realize some higher returns, particularly if that debt, the cost of that debt, is below the income, the yield that you're getting on your commercial real estate asset. And that's been the state of play for the last 20 years. Not anymore. Now borrowing costs are generally higher than cap rates, that yield that commercial real estate delivers. And so that model of real estate investment has kind of been flipped on its head with pretty significant consequences. Cap rates, i.e. the yield from commercial real estate, cap rates have gone up pretty significantly. And consequently, values have fallen a bit. Now, it varies by property type. Certainly, the losses have been significant for office. We estimate as much as, wait for it, 50%. That's 50%. Half of office value potentially has been lost. And I think we're seeing transactions in the market that confirm that. For the other property types, the losses have been a little more marginal, maybe 10 to 20%. And certainly what everybody is waiting for is that first rate cut. We believe that that will mark a peak cap rates and hopefully put us on a path of cap rate compression, which will lead to long-term value gains. All this to say, we actually view 2024 here as a pretty interesting time to be in the market, given that we're likely buying at something close to peak cap rates and probably near the bottom as far as pricing goes.
And with that said, and I wanted to hold over into the second segment about interest rates, because I think this dovetails nicely into the conversation about where does real estate fit into a portfolio. And I want to let's focus on institutional investors. I guess the boilerplate question is, does it fit in? Does it still fit in to the traditional institutional portfolio?
Yeah, well, it absolutely does. There's a number of features of commercial real estate that make it well, I'll use the word ideal, actually, for particularly a pension investment or defined contribution or defined benefit plan. The first is most of commercial real estate's total return comes from income. It's that rental payments that we as a landlord collect every month and disperse to our investors. That is a nice, steady income stream that's generally very reliable. And consequently, pension funds in particular, I think, are attracted to the asset class for that reason. And indeed, the allocation to commercial real estate on the part of pension funds has gone up pretty dramatically over the last 20 years or so. A second nice feature of commercial real estate is its strong returns. It's delivered across all asset classes the second highest total return on average, behind only private equity. And as you can imagine, commercial real estate has delivered those returns with considerably lower volatility, i.e. lower risk. So on a risk-adjusted basis, real estate really stands out as probably having the best return per unit of risk. And the yields that commercial real estate delivers are generally higher, maybe not today, but generally higher than fixed income options. And commercial real estate also has the benefit of the potential of value appreciation over the long run. So all of these factors make commercial real estate really quite interesting. What's complicated about commercial real estate, of course, is we're dealing with actual architecture, tangible assets, buildings that are each a little different and come with all the vagaries and management challenges around lease expirations and tenants and leasing the building and fixing the sidewalk and painting the lobby and all the rest, which is, I think, why most investors turn to a firm like ours to manage the investment for them.
And to that end, I mean, you assume, I don't want to put words in your mouth, but you assume as an investor that there's some illiquidity, and you allocate monies based on the things you're describing, which is there's management, there's rent, all the things that have to go into that. But also when it comes to liquidation, you don't just sell a building tomorrow. It's not like you go on eBay and just sell a building. It takes time. You have to find a buyer. You have to line up the contract. So pension funds in particular are building in that illiquidity into their capital needs for paying out benefits.
Yeah, absolutely they are. And of course, this is the downside to direct commercial real estate investment, which is it is not a highly liquid asset. It can be, it's an uncertain venture to sell the asset. And as you note, it absolutely takes time. But of course, that's the flip side of the coin of that steady income and that low volatility, right? Commercial real estate is not priced every day. It's not like a stock. So you're kind of trading that illiquidity for that long-term stability, which again, I think is pretty attractive to a lot of pension plans.
All right, John, last question. And you've talked about the benefits of real estate, and specifically direct real estate in funds like pensions and as an allocation. Should this be something, or could this be something that in a defined contribution plan, and I'm going to brand them for all under 401k, even though they're different code sections, this could be something that could be looked at as for inclusion in, for example, a target date fund?
We, of course, would be certainly supportive of that investment, of including commercial real estate, and particularly direct commercial real estate into a defined contribution plan for all the reasons I already said. And I think today is a particularly interesting time, given that, yields are pretty high on commercial real estate right now. And unlike fixed income, which will probably see yields come in as the Fed starts to cut rates, commercial real estate yields are going to stay at current levels. So it's an interesting time to invest, I think, particularly for folks who are looking for that long-term yield.
Yeah, absolutely. Well, John, great analysis. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Yeah, anytime, Jeff. My pleasure.
And that wraps up this episode of BRNAM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? All you got to do is check out our website. Hey, we're back again tomorrow for another edition of BRN Weekly. We'll have Jane King back live from the NASDAQ to help break down markets, help make sense of it all. And then we'll take a look back at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving. And don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.